in 3, 2, 1. I think we are recording. I think we're recording. So one of the things I wanted to share with you is I just did a Mad River financing for the acquisition by clients of mine in a small town in Ontario of a mall. Okay.
Mm-hmm.
So can I walk you through the numbers?
Okay.
So they bought this mall for $760,000. There's about $11,675 in land transfer tax. Legal fees were about $3,500. Title insurance was another $850. So they spent $776,000 acquiring this mall. It's about 12,000 square feet. So that's a very good price.
Yeah.
That works out to, I don't know, about, I guess, $70 or $75 a square foot. If I were to buy a mall in North Vancouver, it'd probably be a lot more.
Oh, yeah.
Yeah. So they needed $282,000 of cash to close this deal. And they got a first mortgage from the seller. So they got a seller take-back mortgage for $494,000. So they didn't have to go to the bank, but they did need to raise $282,000. Okay?
Yeah. Yes.
Now, they also have to renovate this. So once they buy this building, they have to they want to put some new signage up. They want to fix up the facade because it's old and tired. They're going to do some minor renovations on the ground floor. And then they have a second and a third floor to this building where there's some old apartments that need some tender loving care. So they have a budget of $160,000 to upgrade the second floor, and the third floor needs even more work, so it's $340,000. So the total renovation budget is $645,000. So the total investment between buying the building and renovating it will be close to $1.42 million, okay?
Yeah.
Which means, because they were determined not to go to the bank, banks are not easy to deal with. Even Westrock isn't that easy, right?
Yeah.
So they need over $900,000. Okay, so that's the cash that they wanted to have on hand. And they had about there were 3 partners, and they had about $130,000 of their own money. So that's why they wanted to raise $800,000 from investors. Am I making any sense so far?
Yes. Yes.
All right. Now the good news is they have some existing spaces on the ground floor and on the lower level that they can rent, which will produce about $15,500 in income. About 34%, that's my number, comes out for operating expenses. So they would be left with about $10,000 of net operating income from the ground floor. Then they'll have 4 apartments on the second floor, 4 apartments on the third floor. And when you total it all up, they will end up with about $200,000 of net operating income. That's probably pretty good. They might go a little bit higher than that, but that's about where they'll end up with. So if you have almost $204,000 of net operating income, and your total cost is $1.4 million, it means their cap rate is about 14.4%.
Mm-hmm. Yeah.
Which is very good.
Yeah.
The fair market value cap rate, according to CBRE, is about 5.5%. So we think that the fair market value of this building, after it is completed and rent stabilized, will be about $3.7 million.
Yeah. Okay.
The appraiser, Michael Cotman, who's appraising this building, thinks it'll be closer to 3.2 million. Appraisers tend to be a little bit lower. He said maybe 3.5 million, but I'm hoping for 3.7 for these folks. Mm-hmm. But if you remember, they bought it and they'll renovate it for 1.4 million. And even if it's only 3.2 million instead of 3.7 million, they still, more than double their money.
Yeah.
So that's pretty good. So they need from investors $800,000, okay?
Yeah.
And the founding partners, there's 3 of them, are each are contributing about $130,000. That's so the 3 founding partners are putting in $127,000 of cash, and the investors are putting in $800,000. So in theory, if you just, you know how it works, if you have if somebody puts in $800,000, in theory they should get 800,000 divided by 800,000 plus 127. So in theory, these guys should the investors should end up with, you know, 86.3% ownership, and the founding partner should end up with a 13.7%, right?
Yeah.
Which would be terrible. So, I mean, and if they were to do that, and since I'm coaching them or I'm coaching you, you know, I would shoot you, right? Basically, I would say, Marilu and Ruben, this is a terrible deal for you. But a lot of people have done deals like this, and there you are, Ruben and Marilu building this 6-plex in Sarnia, or these fellas buying this mall that needs a lot of work, and they're doing all of the work, right? And they're ending up with 13 or 14% of the business. That's a terrible idea.
Yeah.
Okay, so what we did instead was we said that the investors are going to put in $68,000 of their $800,000 as equity.
Right.
And these folks, the founding members, are going to put 100% of their money in as equity. So that means that the investors end up with 35%, right?
Yeah.
Of the business, and the founding partners end up with 65%.
Yeah.
Okay.
Yep.
So and the numbers work, and I'm going to send you this spreadsheet afterwards. Okay.
Okay.
So you'll have it. You can work on your own spreadsheet. But Ruben, what I would like you to try and do is to use my spreadsheet, not your model.
Yep.
Because it's a little bit different, okay? And you know, I know you've got some models that you like, and they're very useful, but this is a little bit different, okay?
Yes.
So I would like you to be able to build spreadsheets like this yourself, and it's easy to do. You'll figure it out in no time. You're a brainiac.
Yeah.
That means you're very smart. All right. So the investors are going to end up with 35%. The founding equity partners are going to end up with 65%. It means, though, that out of the $800,000 that the investors are putting up, $731,000 of it will be debt, not equity, right?
Yes. Yep.
Right. So it's just 800,000 minus 68,398. That's how you get that number. The debt, the term of this debt is 3 years, 8%. With a 20, no, sorry, that's wrong. Sorry,
There is no
8%.
amortization. Yeah.
But it is, the interest is capitalized. Oops. The interest is capitalized for the term. Okay. So that means that at the end of the term, and by the way, we use simple interest. You know what that is, right?
Yeah.
So it's not compounded, because compound interest is dangerous. So, so it means that at the end of the 3 years, the investors will be owed $731,601.92 plus 8% of that times 3. So it's not compound; it's just simple interest. Okay.
Yeah.
And the way that that interest will get paid is hopefully within 3 years. They have an appraised value of 3.2 million or 3.5 or whatever it is. It gives them plenty of room to put a new mortgage in place after 3 years, pay out the investor debt, and maybe have a little bit of money left over. Okay.
Yeah.
All right. So that is the plan. 3 years. And by the way, the seller take back mortgage that they got, wherever that was, up here somewhere, was also for 3 years.
Yeah. Yeah.
Right. So that they co-terminate, so that when you refinance, you've got a new mortgage, you pay out the seller, you pay out your investors, and there you go. What's beautiful about this, I wonder if I could try this. I'm just going to see if I can do a strike. Oh, look at that. I can do that in so I struck through that, right? So, you know, investors, and these are the founders, right?
Yeah.
And so I struck through that just so that you guys, when you get this spreadsheet, you'll remember that's what you don't want to do, right?
Yeah.
Okay. So it's a really interesting way of doing this. I think it's fair to the investors. I mean, from an investor's point of view, if I was the investor, if I had $800,000, it means that 3 years from now, most of my money, over $700,000 plus some interest, is coming back to me. And for just 70 grand, I own 35% of this building forever. Right? So from the point of view of the investors, this is the Mad River financing that I've been talking about for a year now. From the investor's point of view, it's a fantastic structure once they get their money, most of their money back, because it's debt. But from your point of view as an entrepreneur, or my point of view as an entrepreneur, I've done many deals like that for myself. It's a fantastic deal for you too as an entrepreneur, because you don't end up with 13 or 14% of the business. You end up with 65%.
How did you come up with the? Because I see that 68,000 is about close to 15% of the 800.
Right.
So
No, this is okay. This
no,
it will be 60%. That means you find the 35% like this.
So the way I calculated this, Ruben, was I have a lot of experience doing these deals. Like, we've done literally hundreds and hundreds of them, okay? And I'm not just talking about myself. I'm talking about myself and 2,500 coaching clients. We've done hundreds of these. So you remember they needed $195,000 of total equity to close this deal. And they have, amongst the three founders, they had 127,000. So
Yeah,
that told me that they needed $68,000 of additional equity to make this whole thing work. So that's how I ended up getting this number, right?
It's a three ruler. Yeah.
Yeah, and you know, in theory, we could have made this a smaller number. We could have. In other words, if you and Marilu wanted to end up with 75%, then you could arbitrarily reduce this number, and you could just increase the debt. So you could play with this. Okay, once you have the spreadsheet, you can play with it.
Yeah.
Yes.
Okay.
But I can tell you from experience, and you know as well, because you've had some experience now trying it yourself, if you squeeze the equity portion that they get down too low, they'll walk away.
Yes. No, I know. Okay, so trying to extrapolate this into something like the building, and this is just it's something like a question. RBC, and we talk about RBC, right? RBC might be willing to finance the construction up to about 70%, right? On this, on that. So we'll need something similar to this. I mean, instead of being a vendor payback, is RBC in position. The only condition that they put already forward is that whoever is coming into the deal had to be shareholders, which is this thing, right? Giving up a portion of the equity, because at this moment the company that owns that piece of land is only ours, right? It's 100%. Yep. But at the same time, we own the fiveplex, right? That same company owns the fiveplex, which actually increases the value in total of the company for any shareholder, because we won't be able to, or maybe I don't know. I mean, if we're gonna be able to get the fiveplex, what do you call, outside that deal on the it's something that I need to talk with the accountant. If we're gonna do only the building itself,
Yeah,
And
I agree with you on that, Ruben. I think that the new sixplex should be a standalone project.
yeah.
Do not, that fiveplex should be removed from this.
Well, one time at the accountant or Steve, I don't remember, they were saying that, I mean, we can put certain, and that is also part of this question that I put forward, right, in terms of the, the investors. But I guess that could be another question. But this is actually very applicable to this building.
I think it is, but I'm not quite finished yet, okay?
Yes.
Yeah.
Yeah.
All right. So in this case, because there are some outside investors, this building was bought inside a company. So they created a new company. I changed the names to protect these folks. So I'm going to call it AC Holdings Inc. That's not the actual name of the company.
Yeah.
So they created a new corporation called, well, I'll call it here AC Holdings Inc. And the money that the investors put in as equity bought them preferred shares. You remember what preferred shares are, right?
Oh, okay. That's one of the other questions that I want clarification on.
But
Right.
just let me go through it. So preferred shares, you guys know what they are, right?
Well, not
Okay.
completely clear. Right.
So Marilu and Ruben, as the founders, will issue themselves in this new company common shares, which are controlling shares. Common shares are controlling shares. In other words, they have votes.
Yeah.
Preferred shares do not have any votes. Generally speaking, they don't have any votes. So what I do and what I coach people to do, it's up to you, of course. I mean, I'm not your boss. I'm just your friend and coach. But what you would do here is your investors would get preferred shares that would not have any voting power whatsoever. They have no votes. And the reason that investors prefer preferred shares, at least the investors that know anything about anything, is they don't want to have a vote. And the reason they don't want to have a vote is they want you and Marilu to wake up at 3 o'clock in the morning worried if the plumbing is frozen.
Yeah, take a decision. Yeah.
They don't want, look, as an old fellow myself, I don't want a tenant to call me at 3 o'clock in the morning, hey, my pipes are frozen. That goes to Marilu.
Yeah.
I want to make absolutely 100% clear, because I'm an investor in a few buildings when I had more money, that is, and I have preferred shares and the common share, I don't have any votes and I don't want any. Okay, I want to make sure that it's absolutely 100% clear that the buck stops with you. However, there are some other advantages of having preferred shares. Okay, so if you can read this little bit on my screen here, is in the companies that I've invested in, I just heard my email go, I got to make sure I've got this covered off. No problem. I'm trying to get this deal closed. So coming back here, if you read this, they have preferred shares, at least the ones that companies that I have created and my coaching clients have created, have what's called dividend protection. What that means is, let's say this company is successful and they declare a dividend. So in this case, Marilu and you and Ruben, you would say, hey, listen, we made $100,000 this year. Let's have a dividend, but let's only dividend it to ourselves, not to the preferred shareholders, because they don't have any votes, right? So you could just, dividend out all the money to yourself and say to heck with your preferred shareholders. But in the actual corporation documents, the preferred shareholders have dividend protection. What that means is you can declare a dividend for the preferred shareholders alone and not yourself, or for them and yourself, but not for you and not them.
Yeah.
All right, because you don't want to treat your preferred, for me and to the people I coach, we treat our investor money better than we treat our own money, if you know what I mean.
Yes.
Yes.
We want our investors to be taken care of because they're helping us. We're helping them too.
Yeah.
So dividend protection. The next thing you have to know is if there's a problem with the company, and the company, you know, gets behind on its mortgages, or you know, isn't making enough money. If the company is wound up or dissolved or goes bankrupt, the debt gets paid first, and then if there's any money left over, it goes to the preferred shareholders. And only after they've been repaid do you get any money.
Yeah.
You are the bottom of the heap. So it means that when you are building this sixplex in Sarnia, you want to make absolutely sure, to the extent that you can, that this is successful, because as common shareholders, if things go wrong, you're the last to get paid. Do you understand?
Yes.
Yes.
Okay.
Okay. What about a fixed percentage on a yearly basis of the profit? Because this is dividend. I mean, this is.
I would strongly recommend against that.
Because people might say, okay, well, I mean, yes, in this case, they are getting paid that interest rate on a portion of their money. But when people talk about preferred shares, I think because of when I talk to some people here, they expect kind of a fixed return on their money on
I understand that. I understand that. They are getting a fixed return on their money because most of their money has come in as debt, and they're getting 8% on that.
I see.
On their equity, they're just like you and me. They're in it. If we make money, they benefit. If we don't make money, they don't get a dime. But they do get 8% on their debt, which is most of their money.
Yeah, it has to depend on the income on the.
Right. Yeah.
Definitely.
So when it's called preferred shares, doesn't mean exactly that they're gonna be getting a number. I mean, a percentage on those 68,000.
No, they get their share of the profits if there are any profits. If there are no profits, 35% of zero. Last time I checked, is still zero.
Okay.
All right.
Yeah.
But there's a few other things you need to know.
Mhm.
The other thing is, there's a thing, right, which you can see right at the end here of my sentence. There's something called a tag-along provision, and that's very important to preferred shareholders. And what that is that, let's say somebody comes along and makes you an offer, Marilu and Ruben, and say, look, we love this sixplex, we want to own it, but we only want to buy the 65% of the shares that you own, right? The 65% of the equity that you own.
Mm-hmm.
We don't care about the preferred shares. Let them sit out there. And they make you a ridiculous offer, right? And you are not allowed to accept that without including the preferred shareholders. So you would have to say to me, if I made you a ridiculous offer, say, Bruce, it's great that you want to buy 65% of the company, but you have to make, it's either you make an offer for the whole thing or nothing. And that's another way to protect your preferred shareholders from being abused.
Yes.
All right.
Yeah.
It's called a tag-along provision. And then I just added here another thing here. I'll just highlight it here. I don't like that color. Just give me a sec. Holy shit. So I just added this here. Just color it blue or something. The other thing that this is optional, but I have done this in a number I've done this on a number of occasions, and that is, if you get into financial trouble, you're not paying your mortgages, something else has gone wrong, then that could trigger preferred shares becoming voting shares.
Mm-hmm.
And then if they become voting shares, they vote you out and they kick you out, right? Maybe you're doing a bad job as property managers. So I'm not saying you should put that in there, but I have put that in there to protect preferred shareholders. Now, the likelihood of this ever happening to you, Ruben, and Marilu is, in my opinion, zero. But you can imagine sometimes there are people who, things are going well, then they get divorced, and then the husband starts drinking, and the wife loses interest, and now you've got a property that's an orphan. Somebody has to take care of that. That if you have this in there, it allows the preferred shareholders to at least have the option to come in and start managing the business.
But how can they vote you out? I mean, as the 65%, because the vote is still a minority vote. They become voting shares.
That is correct, but you can put in provisions. It's up to you. If you don't have to put this in at all, the only people who are going to see this spreadsheet is you, not your investors. But you can put in there that they become super voting shares. So maybe they get 10 votes for every preferred share, you know, and in which case they are now in the majority and they can kick you out.
Right. Yeah. Okay. Got
I'm
it.
not saying you should do that, but I've seen that that happen. Okay, so I'll just that's an idea. Now, one more thing. One of the things that people really like is they like to get lots of shares. Makes them feel like they got a lot of value. So I just arbitrarily assigned 10 cents a share. I just pulled that number out of the air. It means that for their $68,000, they get almost 684,000 shares. It makes people feel like, oh, I own like almost 700,000 shares.
Yeah, yeah.
And if we're right, and this building goes up in value over time, that 10-cent share might be worth 25 cents. And people love that stuff.
Mm-hmm.
So you could make these shares if you wanted to. You could make them, $1,000, right? So if you made it $1,000 per share, then you'd only be issuing 68 shares. It just feels like it's not enough.
Yeah.
That's just psychological.
Yeah. Yeah, I got it.
So I just did it there. And I priced the shares for the common shares at the same price, 10 cents a share, which means you get 1,270,250 common shares, which goes to you and Marilu because you're the founding equity partners. And these are the voting shares, right?
Yeah.
And I'm going to tell you something. This structure works unbelievable. And if we were to do another webinar together and we did it with this structure, I think we'd get some investors. We did, sorry, I was going to say one, but that's not true. We did 2 webinars with the fellows. These are Toronto fellows. We did 2 webinars and we raised $800,000. It took 2 weeks.
One of the decisions that we will have to make once we get all the the site plan agreement and the drawings, which is in the progress right now, is should we go with RBC or raise the entire construction mortgage, the entire construction cost with investors, right?
I would strongly recommend for you and Marilu, if Royal Bank would give you 65 or 75% loan to value construction financing, you take that. I think that makes sense. It gives you, every time you gear, it's called gearing or leveraging. Every time you gear or leverage a project, it's better for you and your investors. Why? Because it means you can do more projects.
Right. Yeah. Because I mean they're very keen. Actually, the other day we had a meeting. The vice president of that commercial division in London, two of the other guys that we've been working with. We were about 7 people in the call, and they were all interested because we talk about the self-storage, we talk about the Maxwell mortgage, which they are taking over right now because as we mentioned this, that we get in the mortgage with RBC to finance the building in Wyoming. Actually, it's closing in about a week. Because the building is coming in July, so I just wanted to get some of the money ahead of. I mean, So RBC is actually, liking it.
Yeah. So I'm sending you this spreadsheet that we just walked through, and it'll be on your email in about 2 or 3 minutes, I guess.
Maybe what we should be thinking before ahead of time is maybe we should sell that property from 103 to the new company, right? Because before the building is in place, the property is worth only about $200,000, so the capital gains will be kind of relatively small at this moment, right? So we sell the land, right? I mean, the piece of land goes to the new company. That's where we can bring in these investors with the new land, and then we
100% agree with that. And I think that makes a lot of sense to me. Every time you have another potential property that's separate from the others, it gives you more alternatives and more financial flexibility. It does.
Yeah, and that way we leave the fiveplex alone, which, by the way, again, RBC is looking into refinance that fiveplex, so we might get all the money out. They just gave the building. Just a quick comment. The building we bought it for $253,000 in 2017, and they appraised it at $460,000, and RBC is willing to give $285,000 more.
That's fantastic. That's awesome. I mean, you guys are like, it's magic from a hat. You got a hat, you keep pulling rabbits.
So we might get close to between $80,000 and $90,000 out of that building, which we can do. He's going to go into this property. We can put it back in Champlain, but just thinking a little bit ahead. But we'll keep around the building topic. But I think this is something that we also can think for Champlain in a couple of years.
100%.
Instead of doing this RSP and all of that, if we bring in, because that's another thing, when we bring in Royal Bank in 2 years, right, in Champlain, they will want to see the shareholders to be shareholders. They don't like, and they already told me up front, they don't like this RSP mortgages into their thing, right? So
I know that. And so, I mean, I get it. And you understand very, very well what you're doing now. I mean, you've got it. And Ruben, once you have, you've done a few of these transactions, it's like turning a crank and out come the sausages. Once you've done, 2 or 3 projects like this, you can do 20 or 30, and they're all the same. You just turn the crank and out come the sausages, right?
It's to find this kind of, like in apartment buildings right now, it's getting very tough, right? But it's to find, the deal that can place this. So, and I think Champlain next year is going to be very, very well positioned, because if we are now showing, say $10,000 a month, right, on income.
Incredible.
It's totally different now from the point of view.
And what I think is happening is the valuations for many storage businesses, as you know, have gone through the roof. And you bought this thing, I always forget, but it was like 400 and something thousand, right? And, I've seen your models. I'm telling you, I'm very, very confident that Champlain will be worth $5 million and maybe quite a bit more. You got 20 acres there, and maybe in the next 5 to 10 years you could drive it to 5 million, 6 million, 8 million. I really think that's possible. Very doable. Yeah. And you shouldn't stop until you do. I mean, you understand now, because we've been at it a long time, you and I. You understand now how to make it happen, and the hard part, believe it or not, is actually done.
Yeah, it looks like
the hard part is done. I mean, it's not easy to do what you guys did. I mean, you live like 5 million miles away, and on the left coast of Canada, and you did it in a friggin' pandemic.
Yeah, in a pandemic.
And you couldn't even travel half of the time, if not 3/4 of the time, not safely anyway. So I mean, I give you permission to do a little of this.
To a little celebration. Hey, one thing, I mean, and it's something that, we have to decide, and it doesn't have to be right now. We're running out of time. But at the very beginning, you told me that you wanted to run this coaching for 6 months, and then we agreed to go for another 6 months, right? So we are kind of at this point right now. So, I mean, the question is, okay, well, should we go? Should we put a hold on it and then come back in?
It's entirely up to you, because I really enjoy working with you. If you want to put it on a hold on it for June, no problem, and we'll start again whenever you need some help.
Oh, we were thinking to do, okay, this is the idea, and just put it forward. To do June, right? Two sessions.
Yeah.
But the session in June, at the end of June, we'll do it in person, if it's possible.
Oh, that'd be really cool.
Yeah. So we do it in a restaurant.
But anytime, look, I can't really do as much coaching now as I get closer to 70 as I did 5 years ago. I have fewer clients now just because, I get a bit tired. But I really enjoy working with you, and I'm expecting big things from you guys. So you tell me if it's at the end of June, you want to put it on hold, that's fine with me.
Okay, because we're thinking, because we might retake it when the building in Sarnia is getting ready, for construction, which is going to be until probably the beginning of next year, right? I mean, it's not going to be right now. But yeah, I mean, we can talk about it.
You guys, you know my email address. So if you need some more coaching, we'll come back to it, and I've really enjoyed it. So what I would like to do, though, in the next session is I'd like to walk through some of the other things you've asked me about.
Yes.
I have some critical path schedules I'd like to show you.
Yes.
On construction projects, because I'm going to ask you to learn how to use the program that I use, and I'll show you how to do that. I'd also put on the agenda a critical path schedule. Are you ready down, Marilu?
Yeah.
So I'd like to show you a critical path schedule. I'd like to show you a construction budget, an actual budget. I'd like to also walk through augmented tenancy, because I have some really cool things I think you should look at.
That's
so
great.
Those would be things that are very relevant to what you're doing, with your sixplex.
Yes.
And it can really help you. So we'll pick that up in early June, and then the last one we'll do in person.
Yes, that's the plan. So what is the date?
Let's look at some dates while we're tidying up here. So
let me see my calendar, because I got a couple of.
I got some audits coming up.
Yeah, I got. So let me just. Okay, let's see, what is this in here. Oh shit! I closed this one. Okay. All right. In June.
When are your audits?
I got 9, 10th, and 11.
Yeah. So what about on the 8th of June at 11 a.m., which would be 8 o'clock your time?
That works?
Yeah.
That works? Okay. So put it down. Ruben.
And 8.
Marilu.
8 a.m.
I say 8 a.m. Yes.
Yeah, it's 8 a.m. your time. Ruben.
We don't have classes.
Marilu. Okay.
It's a Tuesday, yeah.
Okay, I'll send you the Zoom link on that. And then let's put one more in there. Just let me go to Zoom first before I forget. And don't forget to send me that updated, that updated agenda for that meeting. I count on you guys to do that.
Yeah.
All right. So June 8th at 11 a.m. my time, 8 a.m. your time. June 8th at 11 a.m. All right.
Okay, got it.
All right, I'm going to send that I'm going to send I'm going to send you the link, Zoom link.
Yeah, and then the one at the end of June, we'll decide once we know the travel
Yeah,
arrangements.
we gotta figure, there we go. Yeah, okay, it's off to you. So yeah, we'll do something at the end of June when you're here, and you know, I really want you guys to put those containers in the basement. I really want you guys to do 2 or 3 workshops. Marilu, once you have some experience renting those workshops, you'll have contractors who are already there who'll say, you have like a little office or workshop I can use that's heated. They'll be all over it, I think.
Yeah.
The people like it.
Yeah, so we are putting together the renovation budget. We don't have it yet, but you know, we are looking that we're gonna do it.
Give that a priority. Don't wait for, you know how cold it gets here, right? Don't wait for November.
Oh yeah, we have to do that, right? You know, that's
You
what.
should do that just as fast as you possibly can. All right,
Yeah.
guys, I'll see you soon, okay?
Okay, Susan, thank you.
Thank you, Bruce.
Good job. And I have a recording of this. I'll upload it to YouTube and send it to you.
Okay,
Yes.
very good. Okay,
Okay.
thank you, Bruce.
See you
Have
soon.
a good day.